Biggest threat, Kelly, is everyone's concerned about right now is the continued stock market volatility. Everyone's concerned, and why it could be challenging to get a decent return in the stock market for the next several years. With the exception of a short stock market correction like we saw during COVID, during the pandemic, investors enjoyed one of the longest bull markets that I can remember. It's lasted since 2009, about 12 to 13 years. But today is a new day, isn't it? Today we're facing significant headwinds, including soaring inflation, geopolitical turmoil, rising interest rates, and really what the Fed's doing as far as tightened monetary policy. It's having tremendous impact on the volatility when it comes to this stock market. Now, even the biggest Wall Street cheerleaders out there are saying, don't expect the same returns that we got the past handful of years. It's going to be a more challenging or a bumpy road ahead, and you're seeing this happen right now.
And I'm sure, Michael, with your clients, all this volatility is starting to make people nervous, especially if you're nearing retirement or in retirement.
Well, it is, Kelly, but the worst thing you can do during a market volatility is really panic sell or make emotional knee-jerk decisions. When you panic sell, you lock in those losses and you can miss out on any potential gains when the market does eventually recover. And we sit down with a lot of clients, we do a lot of reviews, and when we customize their plan and putting together income plans, a lot of our clients are not concerned. They're not down as much with the stock market because we understand risk. The process that we take people through is extremely important. We're not going to put someone in an ultra aggressive portfolio when they should be moderate conservative. So again, understanding risk is extremely important when looking at overall stock market volatility. And we've been indoctrinated into believing buy low and sell high, and we all know this, but how many people actually do that? So when the market falls, everyone gets nervous out there, and some people might want to go to cash. This is not the time to go to cash. Nobody wants to lose money. I get that, but missing out on these gains when the market recovers is even worse.
Absolutely. And I bet there's people out there who are trying to time the market with all this volatility, which, as you know, is it's difficult for everyday people to time things out just perfectly, isn't it?
Well, you're right, Kelly, but if you have a solid retirement plan, and again, not just investment accounts, but actually having a retirement plan, understanding where money is going to be coming from. You should have some money that's your safe money for the next 3 years. So regardless of what ends up happening in the market, your income is not affected for the next 3 years. You should also have a bucket of money that's going to be income later on down the road, call it your safe money. And then you're going to have another bucket of money that's going to be your growth money. But there's always someone out there trying to really time the market, but it's impossible to do this. You're better off really establishing an investment strategy like we just discussed that doesn't revolve around getting the timing of the market right. There's no way to tell when the stock market will bottom out or reach an all-time high. So the saying goes, it's time in the market, Kelly, not timing the market. But by sticking to your long-term investment strategy, a few market fluctuations should be easy to navigate.
With all of these stories that we see on the news every single day, Michael, should retirees start to feel worried about market volatility?
Well, certainly, a lot of people are looking at their statements day in, day out, and they're seeing that the accounts are going down. But if you are positioned properly, based off your risk tolerance, you shouldn't see that much of a loss. We've done a lot of reviews with clients, and a lot of clients are happy with the way we've structured things. But if you retire, really during a strong economy and a bull market like we talked about earlier, the wind is really at your back. You're really on easy street, and this could help your money last a lot longer in retirement. But according to CNBC, there's a great article. If you retire during a downturn in the stock market or a bear market, the combination of losses to your investments and the need to make withdrawals to pay for your everyday retirement needs could leave you with 2/3 less money for the rest of your life. This is what we call sequence of returns risk, and why you can't ignore the impact or take it lightly. And this is one of the reasons why we stress about having a plan, not just have investment accounts, But having a plan that is going to give you income in the first 3 years, maybe for years 4 through 7, give you more income, and then having growth so you're not affected by what's happening today in the stock market.
Yeah, and I want to talk a little bit more about this sequence of returns risk. Is there any way you can protect yourself against that?
Well, certainly, for that growth money, consistently updating and rebalancing your portfolio is the best defense against stock market swings. You should update and rebalance your investments every 6 to maybe 12 months. Or if there's any significant shifts in the market like we're seeing today, as your investments either grow or shrink, your asset allocation will become skewed, which can really cause a portfolio to be sometimes too aggressive or maybe too conservative.
I liked what you talked about earlier, Michael, and that's risk and how you help people navigate risk because at this point in their lives, there's no time to recover, is there? If they've got a major, something major happens to the stock market and they lose a lot of money, there's not a lot of time
Well,
to
that's the thing is
recover.
we don't want to have everyone have all their eggs in one basket. We want to be diversified in different areas and utilize the tools that we have that, if we're going to have income that's going to be there for the next 3 years, it's not going to be subject to all this market volatility.
So, all of this market volatility, Michael, could have a huge impact on retirement savings. What's the best counsel you can give our viewers today?
Well, Kelly, there could be some strong headwinds coming for investors and this could last for some time. So trying to grow your nest egg in this environment comes with even more risk. And that's one of the reasons why you want to work with a fiduciary advisor. Most people don't typically think of this, but the fastest and safest way you could grow your nest egg right now is by reducing your taxes in retirement. Why? Because the less money you pay the IRS, the more money you have to spend in retirement, right? That's why I put together just for the viewers on the show today. Learn how you could dramatically reduce your taxes in retirement with our free customized retirement tax savings analysis.
Talk a little bit more about how you get your clients through this process.
Well, we really gather some basic information from them. We determine the tax saving strategy that are best suited for their specific situation. And then we'll really sit down and share these strategies with them so you can see exactly how much you could save. Now, many advisors charge a few $1,000s or more for a customized analysis like this, but we're not going to charge you anything, and there are no strings attached.